Okay, so you want to own an insurance company, watch millions of customers send you money every month, invest the cash while it sits there, and pay out only when something goes wrong. Most people drive home safely. Most houses do not burn down. Most businesses do not get sued today. The payments keep arriving anyway. From the outside, it looks like recurring revenue with a panic button attached. Then, on the final afternoon of the year, one of your customers hits another car. At first, the damage looks ordinary: a bent frame, a hospital visit, a claim file opens. Your company places an estimate beside it and closes the books for the year. Then the repair shop finds more damage. The injured driver misses work. Treatment continues. Lawyers get involved. The claim you thought would cost one amount begins moving toward another, and the policy that produced last year's premium is now changing this year's profit. The claim does not arrive as one clean invoice. It arrives in pieces. A tow bill today, a repair estimate next week, medical records after that, a demand letter months later. Each new document changes the picture, and every change forces someone inside your company to answer the same question again. How much is this promise really going to cost? That question follows the owner everywhere. It sits in the claims department when an adjuster opens a file. It sits in the actuarial models when thousands of similar files are grouped together. It sits in the investment office when managers decide how much cash must remain available. And it sits in the regulator's office when the company asks to write more business. That is the part the monthly payments do not show you. An insurance company receives the selling price before it knows the final cost. The cash arrives first, the true bill arrives later, and the entire economics of owning the company sit inside that gap. Before we follow that claim any further, there is one ownership distinction worth making, because people use the phrase insurance company to describe several different businesses. An agency sells policies for carriers. A shareholder can own part of a publicly traded insurance group without controlling individual policies. A mutual insurer belongs to its policyholders. The carrier is the company named on the contract, the one that actually bears the covered risk and has to pay valid claims. That carrier is what we are talking about. Mainly a United States property and casualty insurer covering things like cars, homes, businesses, injuries, and physical damage. If you buy one, you do not just buy a logo, an office, a customer list, and an investment portfolio. You inherit every promise already sitting inside it. When Berkshire Hathaway bought Allegheny in 2022, the price was approximately $11.5 billion. The acquired company came with roughly $35.59 billion of assets. That sounds like an extraordinary bargain until you look at the other side of the page. It also came with roughly $24.085 billion of liabilities, including about $15.08 billion of unpaid losses, and roughly $3.536 billion of unearned premiums. The buyer received investments, businesses, staff, data, and customers. It also received claim files that were still developing and policies whose coverage periods were not finished. That is what ownership means here. You do not acquire the money without acquiring the promises attached to it. Now take one customer who pays your company $100 for a policy lasting a year. The full payment lands in the account on day one, but the company has not yet completed the job. It still owes 12 months of protection. After the first month, only part of the premium has been earned. The rest belongs to future coverage. Accountants call that remaining portion unearned premium, but the plain meaning is more useful than the term. The cash is present. The obligation is still ahead. So the first question is not how much premium the company collected. It is how much of that premium has actually been earned. The second question is what survives after the company earns it. Part of the money pays claims. Part pays the people and systems that investigate those claims. Then there are commissions, advertising, policy processing, technology, customer service, salaries, premium taxes, regulation, and the ordinary cost of keeping a national promise operational every hour of the year. Insurance companies compress the claim side and the expense side into one closely watched number called the combined ratio. In simple terms, it shows how much of each premium dollar was consumed by claims, claim handling costs, and underwriting expenses. Below 100 generally means the insurance operation produced an underwriting profit before investment income and certain other items. Above 100 generally means the company spent more on the policies than it earned from them. In 2025, the United States property and casualty industry reported a combined ratio of approximately 92.9. So, in aggregate, about $92.90 of every $100 of earned premium went to claims and underwriting expenses, leaving a little over $7 before investment income and other items. That was the strongest industry underwriting result in more than 2 decades. It was not a normal margin every owner can assume will repeat, and even in that unusually strong year, the expense ratio alone was approximately 25.8. That means the customer who never files a claim is still not pure profit. Someone had to find that customer, someone had to price the policy, a system had to issue it, a service team had to maintain it, regulators had to be satisfied. The company had to remain ready to respond even during the quiet months when nothing appeared to happen. The distribution choice changes the shape of that expense. A carrier using independent agents may pay commissions because the agent already has the customer's trust and attention. A direct carrier may avoid part of that commission, but then it has to buy the attention itself through advertising, software, call centers, and constant customer acquisition. The expense does not vanish. It changes clothes. That is why a busy advertising campaign is not automatically evidence of strength, and a large agent network is not automatically evidence of waste. The only useful question is what it costs to acquire and keep a policyholder relative to the premium and claims that policyholder ultimately produces. This is why a large premium number can be comforting and useless at the same time. It tells you how much business moved through the front door. It does not tell you what will remain after every promise works its way through the building. Go back to the collision at the end of the year. The insurer cannot wait until every doctor, repair shop, lawyer, and court has finished before reporting its financial results. It has to estimate the unfinished claim now. That estimate becomes a loss reserve. Some reserves relate to claims the company already knows about. An adjuster has opened the file, inspected the damage, and placed an expected cost beside it. Other reserves relate to events that have already happened but have not yet been reported. The industry calls these incurred but not reported claims, or IBNR. Somewhere inside the book, a loss has already occurred. The company just does not know its name yet. A worker may not understand the full effect of an injury. A business may not have received the lawsuit. Damage may be hidden. An accident may happen just before the reporting period closes. The claim file is missing, but the economic event is real. So the balance sheet contains bills from people the company may not know, for events it may not have fully recorded, at amounts that can still move. Across the entire United States property and casualty industry, those estimates added up to approximately $1.03 trillion of loss and loss adjustment expense reserves at the end of 2025. About $869.2 billion related to unpaid losses, with another roughly $162.9 billion for the expense of handling them. That number is not a vault containing one labeled envelope for every future payment. It is the industry's best current estimate of an enormous collection of unfinished outcomes. Picture claim files arranged by the year the underlying events occurred. The newest row is still filling quickly. Older rows look calmer, but they are not always closed. A court decision, medical development, repair cost change, or new piece of evidence can reach backward into one of those rows and move the estimate again. That does not make insurance impossible. Large numbers help. A carrier does not need to predict whether one specific driver will crash. It needs a reasonably accurate estimate of how often a large group of similar drivers will crash and what those crashes will cost. But the group only helps when the future behaves enough like the past. Repair prices rise, medical costs change, court decisions alter liability, claim frequency moves. Inflation makes an old estimate weaker. Long-tail liability claims can remain unsettled for years. That is when the claim from the opening comes back. The policy has expired. The file is still open. New information pushes the expected cost higher, and the insurer must strengthen the reserve. That additional amount reduces current earnings even though the premium was collected in an earlier period. The reverse can happen too. If an earlier estimate proves too high, part of the reserve may be released, increasing current earnings. Neither outcome automatically proves misconduct. Estimation is built into the business, but the timing creates a dangerous possibility. An insurer can look profitable because the difficult claims have not finished developing yet. Yesterday's pricing mistake can hide inside today's growth. At this point, the business may sound like a machine designed to produce uncertainty. Premium is not immediately earned. Claims are not immediately known. Old policies can change current earnings. Even a quiet month may contain losses that have not been reported. And yet some of the strongest investors in the world have spent decades building insurance companies. The reason is the same timing gap that creates the danger. The insurer receives money before many claims are paid. While it waits, it holds funds connected to unpaid losses, unearned premiums, and other insurance obligations. Those policyholder-related funds are called float. Float is where the ownership fantasy becomes attractive again, but in a more demanding form. It is not money the owner can pull out and spend. It remains attached to claims, liquidity needs, and capital requirements. The company has to keep enough high-quality assets available to honor the contracts, but while the insurer holds those assets, they can earn investment income. At the end of 2025, Berkshire Hathaway reported approximately $176 billion of insurance float. Across the preceding 3 years, its combined insurance operations also produced underwriting gains. That means Berkshire was not paying for the privilege of holding that funding. The insurance business itself was profitable, while the supporting assets remained available for investment. The average cost of the float was negative. That is an extraordinary outcome. The company is paid for accepting the risk, and then earns investment income while waiting to settle the obligation. But now return to the unfinished collision. If the claim costs more than expected, the premium was too low, expenses were too high, or thousands of similar policies were mispriced in the same direction, the float was not free. The company bought that funding by accepting losses. An insurer can still report overall profit while losing money on underwriting if investment and other income are large enough. But that is not a durable excuse for bad pricing. Underwriting losses consume capital, they raise the cost of float, and they become most dangerous when claims demand cash at the same time investment markets are weak. The scale of that second income stream is easy to see in the industry totals. United States property and casualty insurers earned approximately $88.9 billion of net investment income in 2025. Industry net income reached approximately $150.6 billion. Those numbers do not mean every insurer was healthy, and they do not erase the difference between underwriting and investing. They show why the timing matters so much. At industry scale, even a modest return on assets held against future claims becomes an enormous source of income. The strongest version of insurance is not investing instead of underwriting. It is underwriting well enough that the investment funding arrives cheaply. That creates a problem the monthly premium counter never reveals. Every new policy adds cash, but it also adds risk. The company needs financial capacity to support both. The cushion above the insurer's recorded liabilities is called policyholder's surplus. It absorbs uncertainty and supports additional business. Regulators also use risk-based capital, which ties required capital to the amount and nature of the risk the company writes. The practical meaning is simple. A regulatory license and a published minimum capital figure do not let a new owner sell unlimited coverage. As the book becomes larger, more volatile, or more concentrated, the cushion has to grow with it. Growth can fill the account and weaken the company at the same time. Now put thousands of those policies in one place. A single isolated collision is what insurance pools handle well. One storm crossing a region is different. It can damage thousands of homes and vehicles at once. The claims are no longer independent. They move together. The insurer protects itself by buying insurance from another insurer. That is reinsurance. Picture the losses as layers. Your company keeps the first layer. A reinsurer agrees to absorb a defined portion above it, up to a limit. The contract can protect capital and allow the primary insurer to write more business than it could safely retain alone. But the protection has a price. It has an attachment point where it begins. It has a limit where it ends. It can contain exclusions, and the original customer still holds a contract with your company. So the decision is not simply whether to transfer risk, it is how much risk the company can afford to keep without surrendering so much premium that the business no longer works. Retain too much, and one concentrated event can damage the balance sheet. Transfer too much, and the insurer gives away the economics it was created to earn. Suppose the storm arrives late at night. By morning, phone lines are full, roofs are open to the rain, damaged vehicles are blocking streets, and adjusters are being sent across the region. The policyholders do not care how elegant the insurer's capital model looked the week before. They want the promise to work now. The company begins paying the first retained layer from its own resources. As losses cross the contract threshold, it starts presenting recoveries to the reinsurer. But every dollar still has to fit the wording, limit, and timing of the agreement. A layer on a diagram becomes thousands of individual families and businesses waiting for payment. A storm makes that tension visible in one afternoon. Ordinary underpricing can hide it for years. A company can add policies, collect more premium, grow market share, and increase the size of its investment portfolio while the quality of the book is quietly getting worse. The warning may not appear until repair costs rise, customers claim more often, courts become more expensive, or reserves from earlier years need to be increased. By then, the company has already made the promises. This is where one of the largest automobile insurers in the country becomes useful, because the headline revenue barely moved while the economics underneath it reversed. Geico earned approximately $38.984 billion of premium in 2022. Its pre-tax underwriting result was a loss of approximately $1.88 billion. The combined ratio was approximately 104.8. The company brought in almost $39 billion of premium and still spent about $104.80 on claims and underwriting expenses for every $100 it earned. Berkshire said the result reflected higher claim frequency and substantial increases in average claim severity. Parts cost more, labor cost more, medical and other claim costs rose. The price of the promise had not kept pace with the bill. Then came 2023. Geico earned approximately $39.264 billion of premium, only modestly more than the year before. But the underwriting result moved from a loss of approximately $1.88 billion to a profit of approximately $3.635 billion. The combined ratio improved from approximately 104.8 to approximately 90.7. The premium bars were almost the same height. The result moved by more than $5 billion. That is the number worth watching. Berkshire attributed the improvement to higher average premiums per policy, lower claim frequency, favorable development in earlier claim estimates, and lower advertising costs, while noting that average claim severity was still rising. The improvement continued. Geico produced approximately $7.813 billion of pre-tax underwriting profit in 2024, with a combined ratio of approximately 81.5. In 2025, it remained highly profitable, producing approximately $6.824 billion of pre-tax underwriting profit, with a combined ratio of approximately 84.7. Even as claim severity and acquisition spending continued to move, Geico has unusual scale, data, capital support, and brand strength. Those margins are not a template every carrier can copy. The lesson is narrower and more important. Premium volume did not explain the reversal. The company could not fix the business by selling more of the same promise at the same wrong price. The relationship between price, claim frequency, claim severity, reserve estimates, customer mix, and expenses had to change. This is the deepest economic asset inside an insurance company, not the premium pile, not the investment portfolio by itself. The ability to decide which risks to accept, what price can support them, how much capital stands behind them, and when growth has become more dangerous than restraint. That last decision is where weak owners get trapped. Growth is visible. It produces customers, premium, market share, and a larger investment account. Discipline is less visible. Sometimes it looks like raising prices, losing customers, reducing advertising, pulling back from a region, or refusing business a competitor is happy to take. Imagine two insurers beginning the year with the same capital and the same amount of premium. The first sees repair and medical costs rising. It adjusts prices where allowed, reduces exposure where the price no longer supports the risk, and buys reinsurance for the concentration that could threaten the company. Growth slows. The second keeps prices low and adds customers quickly. For several months it looks like the winner. More policies are sold. More cash enters. The premium chart climbs. The first company's slower growth may look like weakness in the middle of the year. Sales teams feel the lost business. Advertising produces fewer new customers. Competitors appear to be winning. The pressure is real because discipline often becomes visible before its benefit does. The second company's mistake works in the opposite order. The benefit appears immediately. The cost waits. That timing rewards the wrong decision before it punishes it. Then the claims catch up. The low price attracted business without leaving enough margin for the actual losses. Reserves rise. Earnings fall. The capital cushion weakens. Reinsurance may cost more at renewal. The company now has to shrink after the bad policies have already been written. One company looked cautious before the claims arrived and strong afterward. The other looked strong before the claims arrived and cautious only after it was too late. That is why two carriers with the same premium volume can be completely different businesses. One may have a diversified pool in which ordinary losses remain reasonably predictable. Another may have thousands of customers exposed to the same storm, the same repair inflation, the same legal environment, or the same pricing mistake. The insurer is not simply collecting customers, it is assembling future bills and deciding which ones can safely sit together. So, does owning an insurance company actually work? In the strong version, the company prices risk closely enough that claims and underwriting expenses remain below earned premium over time. It keeps reserves honest even when a lower estimate would make the current year look better. It holds enough surplus that one difficult season does not force desperate decisions. Reinsurance protects the losses that could threaten the company without consuming the entire margin. The investment portfolio stays liquid enough to meet claims rather than chasing returns the balance sheet cannot safely wait for. Most importantly, the company honors the promise it sold. Valid claims are not an inconvenience standing between the owner and the profit. Paying them is the product. Under those conditions, the economics can be exceptional. The insurer earns an underwriting profit, holds growing float, earns investment income on the assets supporting that float, and compounds capital through a business that customers continue renewing. The weak version may look similar for a surprisingly long time. The premium total rises. The investment portfolio grows. The company reports more customers. But the policies were priced for a future that did not arrive. Claims cost more than expected. Earlier reserves need strengthening. Concentrated losses arrive together. Reinsurance protects less than the owner assumed or costs more to renew. The company discovers that the cash it celebrated was attached to obligations larger than the price it charged. That is the final answer to the ownership fantasy. The automatic payments are real. The investment income is real. The float can be extraordinarily valuable. But none of those things become durable owner wealth until the promise survives the future that tests it. Owning an insurance company is owning the gap between a price set today and a cost revealed later. The companies that master that gap can be paid to hold enormous amounts of float. The companies that misjudge it can grow for years while quietly selling tomorrow's losses at yesterday's price.